All right, guys, welcome back. We're going to talk about options here. Okay. So options are another way to leverage your money to do more in the stock market. So I'm going to break down what options are. They are a little bit confusing. So there's a lot in here and there are a lot of additional resources out there that can go more in depth, but I want to explain the mechanics and the basics and how they work as leverage. Okay. So options contracts are just a derivative product from any securities that are trading on the market. Okay. So if you can go out and buy Tesla stock, you can also create an options contract based on Tesla stock as well. Okay. An option contract leverages 100 shares of the security. Okay. But the actual contract has a cost that's much less. So you might be able to buy an option contract for $10 that is controlling 100 shares of a stock, right? It could be controlling thousands and thousands of dollars worth of stock, but the option contract itself could be relatively cheap. Okay. So a fraction of the cost, but you control more securities, more value on the back end. That's why it's leveraged. Okay. So an option contract is simply made when you have the option to buy a stock at a certain price called the strike price or sell a stock at a certain price, the strike price. Okay. The strike price is defined in the contract and there's an expiration date. Okay, there's a time for the option. Could be weekly or monthly options, whatever it is. Okay, so there's a set expiration date and there's a strike price. So it gives you the option. If you are buying the contract, it gives you the option to buy a stock at a certain price or sell at a certain price. Okay, so there's two parties with an options contract. There is the seller and the buyer. The seller is selling the right to either buy or sell stock at a certain price. They're selling that right to somebody else. Okay. For that, they earn a premium. So you, as the buyer, you are paying a premium to the seller for the right to buy or sell a stock at a given price. Okay. So you're selling the contract, somebody is buying the contract. So there are two parties involved here. Okay. So here are the mechanics. When you have a call option, we're going to go walk through examples on this. Okay. There are call options and there are put options. A call option means that the buyer of the contract has the ability to buy the stock at a specified price. Okay, that's a call option. A put option is the reverse. The buyer of the contract has the right to sell a stock at a given price. Okay, so let's talk about call options first here. So let's say that I buy a call option on Apple stock with a strike price of $170 per share, $170 per share. So when I buy this options contract, I am controlling $100 worth of Apple stock. Okay, 100 shares worth $170 each. Okay, so I'm leveraging this. I don't have to buy the 100 shares of Apple stock. I can just buy a contract. Okay, and let's just say that contract is worth $10. Okay, so when I'm buying the call option, let's say I set the strike price at 170. That means that anytime before the expiration date, I can actually buy the stock at 170. I have the right to do that. I don't have to. I don't have the obligation. It's my right to choose to or not. I can exercise the option or not exercise it. Okay. So let's just say the strike price is 170. Let's say the Apple stock, the price increases to $180 per share. I have a couple options here. I can exercise my option and I can go buy the stock from this person, from the seller, for 170 per share. Okay. It's now trading at 180, but I can actually go buy it from the seller. They agreed to sell it to me at 170 per share. So if I did that, then essentially I've locked in a gain of $10 per share, right? Over 100 shares, that adds up, right? It's not just $10, it's $10 per share, and that's 100 shares. So in that case, a $10 per share profit multiplied by 100 is $1,000 profit, right? So I could go buy the stock at $170 per share, so $17,000. They have to sell it to me at the 100 shares at $17,000. I can turn right around and sell those shares on the open market for $18,000 and I lock in $1,000 profit. Okay, that's pretty sweet. That works out really great. Okay, so $1,000 profit for buying a $10 contract. You turn $10 into $1,000. That's pretty good. So I can choose to do that. I can exercise my option and buy the stock. Or let's say I don't have $17,000 hanging around. I can actually just take my contract and what I originally paid for it, $10 a share, but now because the value of the stock has gone up so much higher than the strike price, right? It's trading at 180 versus the option to buy at 170. I can actually just sell or trade my option contract to somebody else. And where I bought it at $10, now it's very valuable, okay, because it's in the money, right? It automatically has locked in profits there. I can go sell my contract and I might be able to go sell it for $20, okay? So instead of ponying up $17,000 to go buy the stock, to trade it to make $1,000, I could just double my money. I bought the contract at $10, I traded away at $20. I have $10 profit. I doubled my money, okay? And you can do this. You could buy 100 option contracts. I mean, it just depends what you want to do, but you can leverage this even further and say you buy 10 or 20 or 100 options contracts that each control $100 worth of shares, or sorry, 100 shares worth of the stock. Then you can see how that could, you could leverage that quite a bit. So instead of just putting in $10 and doubling it to 20, right? If you bought 10 options contracts, you spent $100, you turn it into $200. If you bought 100 options contracts, you turn $1,000 into $2,000, okay? So that is, you have the right to do that. Now, let's just say that the price of the stock goes below 170, right? So I have the option to buy the stock at 170, but let's say the stock actually drops, okay? It goes down below 170, like 160. Well, I don't have to do anything, right? It wouldn't make any sense for me to buy it at 170 from the contract if I can go out in the open market and buy it at 160. So in that case, I can just let my option expire, right? And it expires worthless, and that's it. I'm out the premium I paid, the $10 I paid, I'm out that much, but nothing more. I can also trade it away. There's still some value in this contract, okay? It's not completely worthless because somebody else out there might be like, yeah, it dropped to 160, but I think it's still going to go to 180 before the option expires. So they might come in and say, hey, actually, I'll buy that contract from you for $5. So then you ended up losing a little bit, but you still salvage some. And they are just hoping the stock price increases and they can actually exercise the option. Okay, so there's a lot of people out there with different opinions on how stocks are going to do and securities. And so there's always a buyer and there's always a seller out there. Okay, just the way it works. Okay, that's how a call option works. Okay, so that's the best example there.
Better understanding leads to better outcomes.